cover something quickly which is very relevant to what we're seeing in the markets. Keep in mind one very important thing here, and it's very simple. What the Federal Reserve Bank does with interest rates is not just important and critical to the U.S. economy. In fact, the U.S. economy is on a self-sustaining recovery, in my opinion. Slow, lumpy, but still in the right direction. It's really for the it's also for the benefit, a huge benefit for the global markets and the global economies out there, specifically for the developing world, the BRICS, and the overall emerging markets. So the Fed's not going to do anything that dramatic, as in physically going out there and raising interest rates. I've explained very clearly on my TNX videocast that we could rise higher interest rates are actually better for under the current conditions that we're at right now, um, given that depressed rates, as we have seen in the 2.2, 2.3% 10-year level, are not conducive to good banking. So the banks and overall don't like, given their spreads that they get from lending, um, and the interest rate they can charge. If interest rates are artificially held back that low, then obviously they can't make money, and it's just simple as that. So slightly higher interest rates moving towards a 2.5, 2.6, even all the way up to the 3% level on the 10-year government bond deal, which is a proxy for many other rates such as mortgages and car loans and credit cards and you name it, um, are actually very healthy and a positive catalyst, positive factor for the banking industry. Now, saying all that, let's take a look at something I noticed today, which is emerging markets. Okay, the EEM. I haven't played this in a while because it's such a slow mover, but hey, it's just the way it is. This is a weekly chart of the EEM. Look what it's doing. Now, there's two scenarios that could very well happen, and they're pretty obvious. Okay, one scenario is that this is a triple top. This is a triple top, and it fails. Let me get the drawing tool out. This is a triple top, and every time it's gone here, it's come down. Okay, um, every time it's gone here, let's see what happens. If it does break out, and it can happen, mind you, there's a bunch of big undercurrents happening in China with their stimulus boost that they're doing, and a lot of it is not being talked about. The fact that the Russian markets are quite depressed, and international big money global fund managers are buying into it, and they're also buying into China. So these things affect emerging markets and indirectly affect us in a positive way, and that's pretty obvious. So if you notice what's going on here, one scenario is that we basically break out over this 45 level, or we do the same thing that we have done previously, which is come down, test this lower Bollinger, and then bounce again. So we've yet to see what happens. And when we look at the weekly, we can see that this is a question that remains to be seen. Thursday's ECB announcement, I believe it's Thursday, is very important, because the mechanisms they're going to put into place to boost the European economy are, given that they are in a deflationary spiral, are extremely important, extremely critical for emerging markets too. So let me go out a little bit and see what I see on the monthly charts. On the monthly chart, you can see, and this is interesting, okay, keep this in mind, we can go up to about 49, and we could go past 49, and we can go to 55. That's where we were at in October of 2007. So if we're going to have that big bad fall, well, let's have it from where we were in October of 2007, and that's another 11 points away. On a percentage basis, that's 25%. That's not going to happen overnight. That's going to take months to happen, and this is probably where the peak comes in. So use this as a proxy, if you'd like, to where the markets hit a major top, which I still believe happens. A major top, I believe, happens sometime by the early part of next year, April or so. So I don't know. So on a short-term basis, we could very well get here, where's my drawing tool? We get, I think the triple top, this multiple things does break out this time. So again, I don't control the emerging markets, I'm just telling you what I see. And this pattern does get filled. This is a pattern symmetry in play. All right, top, top, and then this top breaks out to its 49, and that's going to spark off a big rally, global rally. Just letting you all know. So keep this a proxy. Just kind of, it was on one side of my screen, and I noticed it, and as we were down, and just things happened, right? FXI was up 3.5% today. That's another one that I used to play, and I'm going to start focusing on this again. Look at the FXI. This is the iShare China large cap ETF. I know there are different ETFs, which also look at the smaller ones. But the FXI was up 3.32% today. And looking at it, this can go up to about 45. This is the monthly chart. Let's look at a weekly. And the weekly has broken out. Well, slight breaking out. So on a daily, let's see. On a daily, we still have, it's broken out of the Bollinger. It's a powerful move. When things break out of the Bollinger like it did here, look what happened. Okay, it went from 38 up to about 41 before it retraced back. And that didn't happen too long ago. That happened in July. And this is bear with me one second. These things are important because it makes you understand the global economy a little bit better, global markets, how it affects us, and why getting uber bearish at these levels just because our markets are hitting some new highs really doesn't make any sense. I mean, I'm talking about from a dogmatic standpoint. You can't lay out shorts and just go home and expect the market to basically do your bidding. You have to be very quick with the shorts, as we clearly saw today, and because there's undercurrents of these international movements do affect our markets, and so many other host of other reasons which I've mentioned before. Underinvestment by hedge funds, retail investor still out of the game. Overall sentiment truly not bullish, even though over the surface it is. None of us are really going gangbusters and putting 60-80% of our capital to work at one go. All these are prime signs that there's still a lot of cautiousness, and that's good for the ongoing rally. So that's FXI. Let's take a look at what's the other one that I wanted to take a look at? The US dollar Japanese index. Now this is very interesting. Look what happened today, okay? And this correlates directly with what happened here. We hit a let me go back a little bit. I got a minute and a half to explain this. This is the daily chart, okay? Very clean and simple. Daily chart, 105 top. And I showed this other day. So guess what happens? We hit 105 today. So boom, there were some big sell programs at that level, big institutional, sell limits here, whatever you call it, and this is what happened. So what happened next? Now this happened back in December. We hit a top, we pulled back, and then we tried to attempt another top, and we failed, right? So again, same thing here. This probably attempts another top, and if it breaks out, then we're gonna definitely go higher. This is the carry trade. As you know, a weaker yen equals risk on, higher carry trade. So this is what's going on. Now let me show you very quickly. These are things, what makes my service very unique compared to many others. Notice all these things. This is what happened. We hit the peak at 105.30, just like I showed the broader picture, and that was a little after what time was it? Okay, 23:45, so midnight. And then we started selling off, and then we pull up a little bit around 7 a.m. Then our markets open around 9:30. But the bottom line is that the carry trade, there was a risk off day. Look at this, we had a risk off day, and then things turn around 3:30, right before our close, risk on again. So I believe that they're going to try to, in between the zigzag, go up and test the 105 again, which means we're going to test the 2010 level or so on the S&P